Something unprecedented just happened in the gold market. And I'm not talking about another all-time high. We've seen over 50 of those this year alone. What I'm talking about is a signal so powerful, so historically significant, that it's only appeared a handful of times in the last century. And every single time it showed up, the entire global financial system was about to be reset. Let me show you exactly what I'm seeing. Gold just crossed $4,400 per ounce. That's a 68% gain in a single year, the largest annual increase since 1979. Now, if you remember what happened after 1979, you know why that comparison should send chills down your spine. But here's what nobody's talking about. It's not the price that matters. It's who's buying and why they're buying that tells you everything you need to know about what's coming next. Central banks just completed their largest gold accumulation in modern history. We're not talking about a few hundred tons. We're talking about a coordinated global buying spree that's been accelerating for 3 straight years. And the pace isn't slowing down. It's speeding up. Even as gold hits record highs that are more than double where they were just a few years ago, central banks are buying more aggressively than ever. Think about that for a second. These are the same institutions that print money. They can create dollars, euros, yen out of thin air with a keystroke. Yet they're converting those currencies into physical gold at a pace we haven't seen since the 1970s. What do they know that the average investor doesn't? Let me paint you a picture of what's really happening behind the scenes. In the past 36 months, central banks have purchased over 3,000 tons of gold. To put that in perspective, that's roughly equivalent to all the gold held in Fort Knox. They've essentially duplicated the entire U.S. gold reserve in just 3 years. The People's Bank of China has been adding to their reserves month after month. The Reserve Bank of India is stockpiling. Poland, Singapore, Turkey, even countries you wouldn't expect are loading up on physical gold like their currencies depend on it. Because they do. Here's where it gets interesting. These purchases aren't being made quietly anymore. They're being announced, publicized, almost like they want the world to know they're moving away from something. And that something is the dollar-based system that's dominated global finance since 1944. You see, there's a pattern in history that keeps repeating. And once you see it, you can't unsee it. Every major shift in the global monetary system has been preceded by exactly what we're witnessing right now. Massive central bank gold accumulation, currency instability, record government debt, and a loss of confidence in the reserve currency. It happened in 1971 when Nixon closed the gold window. Gold was trading around $35 an ounce. Central banks around the world were converting their dollars into gold so aggressively that the U.S. was hemorrhaging its reserves. France literally sent warships to New York Harbor to collect their gold. That's not a metaphor. They actually sent naval vessels because they didn't trust that the gold would be there if they waited. Within a decade, gold hit $850. That's a 2,400% increase. It happened again in the lead up to 2008. Central banks shifted from being net sellers of gold to net buyers in 2010. They saw something coming. The financial crisis had exposed cracks in the system that couldn't be papered over with more debt. Gold went from $800 to $1,900 in less than 3 years. And now it's happening again. Except this time, the scale is different. The debt levels are different. The geopolitical tensions are different. Everything is amplified. Let me show you something that should terrify anyone holding significant wealth in traditional assets. The U.S. national debt just crossed $36 trillion, that's trillion with a T. To service that debt, the government is now spending more on interest payments than on national defense. Think about that. More money is going to pay interest on past borrowing than to fund the entire military. And interest rates are still historically elevated. Here's the math that doesn't work. The government needs to roll over trillions in debt every single year. As bonds mature, they have to issue new ones. But who's buying? Foreign central banks used to be the biggest buyers of U.S. Treasury bonds. They're not anymore. China has been reducing its Treasury holdings. Japan is selling. The Federal Reserve tried to step in during the pandemic, but they've been trying to reduce their balance sheet. So who's left? The only buyer of last resort is the Federal Reserve itself, which means printing more money, which means more inflation, which means the purchasing power of every dollar you own continues to erode. And that's exactly why gold is exploding higher. But here's what most people miss. Gold isn't rising because of inflation alone. It's rising because the entire architecture of the global financial system is being rebuilt in real time, and most people have no idea it's happening. Let me explain what I mean. For the past 80 years, the world has operated on what's called the Bretton Woods system and its successor, The petrodollar system. Every country needed dollars to buy oil, to engage in international trade, to hold as reserves. This created artificial demand for dollars that allowed the U.S. to run massive deficits without consequence. We could print money, and the world had to absorb it. That system is breaking down. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternative payment systems that bypass the dollar. They're settling trade in their own currencies. They're building new financial infrastructure. And they're backing it with gold. Saudi Arabia, the cornerstone of the petrodollar system, just joined the BRICS alliance. Let that sink in. The country whose oil sales in dollars created the foundation for U.S. monetary dominance is now exploring alternatives. They're in discussions to accept yuan for oil. They're talking about a BRICS currency. And they're buying gold. This isn't speculation. This is happening right now. And the implications are staggering. When the petrodollar system was established in the 1970s, it gave the U.S. an extraordinary privilege. We could export our inflation to the rest of the world. We could run trade deficits indefinitely. We could sanction countries by cutting them off from the dollar system. That power is eroding. And as it erodes, the value of the dollar relative to hard assets like gold is collapsing. Now, here's where this gets personal. If you're sitting on retirement savings, if you have a 401k or IRA, if you've been responsible and saved for decades, you need to understand what's at stake. Your purchasing power is being systematically destroyed. Not by accident, by design. The government can't pay its debts without inflating the currency. Social Security, Medicare, defense spending, interest on the debt. It all adds up to more than the government collects in taxes. The gap has to be filled somehow. And the only way to fill it without defaulting is to print money and let inflation erode the real value of the debt. You're the one paying for it. Every time you go to the grocery store and see prices higher than they were last year, every time your rent increases, every time your healthcare costs go up, that's not just normal inflation. That's your wealth being transferred to pay for government spending you never voted for. And here's the thing that keeps me up at night. We're still in the early stages of this. The gold price is telling you that smart money, institutional money, sovereign wealth funds, they're all moving to protect themselves. They're getting out of paper assets and into hard assets. They're buying gold, silver, real estate, commodities, anything that can't be printed into existence. Let me give you a specific example of how this plays out. In 2020, gold was trading around $1,800 an ounce. If you had $100,000 in cash sitting in a savings account, you could have bought about 55 ounces of gold. Today, that same $100,000 buys you less than 23 ounces. Your purchasing power in gold terms has been cut by more than half in just 5 years. Meanwhile, your savings account paid you maybe 2% interest, while inflation ran at 8%, 6%, 4% year after year. The wealth wasn't destroyed. It was transferred, from savers to debtors, from the middle class to asset holders, from you to the people who understood what was coming and positioned themselves accordingly. Now, I want to pause here for just a moment because this is important. If you're sitting on $100,000 or more in retirement accounts, there's something you should know about. I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. It's not for everyone, but if you're concerned about what we're discussing here, it's worth understanding your options. All right, let's get back to where this is all heading. The gold market is telling us something that the stock market hasn't figured out yet. We're not in a normal bull market. We're in the early stages of a monetary reset, and the speed at which this is unfolding is accelerating. Look at what's happened just in the past few months. Gold has surged from $3,500 to over $4,400. That's a $900 move in a matter of weeks. Silver hit all-time highs, not just nominal highs, real highs adjusted for inflation. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is compressing. That's a classic sign that we're transitioning from a gold bull market to a precious metals mania. And here's what history teaches us about manias. They don't end when things seem expensive. They end when things seem insane. In 1980, gold hit $850 when the average American salary was $12,000 a year. That means gold was worth about 7% of annual income. Today, with median household income around $75,000, that same ratio would put gold at $5,250 per ounce. We're not there yet, not even close. But here's where it gets really interesting. The 1980 peak happened in a world where the US was still the dominant economic power, where the dollar was unquestioned, where debt levels were a fraction of what they are today. We're in a completely different environment now. The debt is exponentially higher, the geopolitical landscape is fractured, the dollar's dominance is being actively challenged. If we're heading into a similar mania, and all the signs suggest we are, the peak could be significantly higher than anything we saw in 1980. Some analysts are talking about $10,000 gold. Others are saying $15,000. The most aggressive forecasts go even higher. Now, I'm not here to give you a specific price target. Nobody knows exactly where this ends. But what I can tell you is that the setup we're seeing right now, the central bank buying, the currency instability, the debt crisis, the geopolitical realignment, this is the same setup that preceded every major monetary reset in history. Let me walk you through the mechanics of what's actually happening in the gold market right now, because this is where it gets technical but critically important. The gold market operates on two levels. There's the paper market, where gold is traded as contracts on exchanges like the COMEX. And there's the physical market, where actual bars and coins change hands. For decades, the paper market has dominated price discovery. Banks and hedge funds trade massive quantities of gold contracts without ever taking delivery of physical metal. It's essentially a betting market on the price of gold. And because the paper market is so much larger than the physical market, it's been able to suppress the price through sheer volume of selling. But something's changing. The physical market is starting to decouple from the paper market. We're seeing massive inflows into gold-backed ETFs. These are funds that actually hold physical gold in vaults. When investors buy shares, the fund has to go out and purchase real metal. That creates real demand that can't be satisfied with paper contracts. At the same time, central banks are buying physical gold, not paper contracts. They're taking delivery. They're storing it in their own vaults. They're removing supply from the market permanently. And here's the kicker. The amount of physical gold available for delivery on the COMEX is at multi-year lows. The ratio of paper claims to physical metal is estimated to be somewhere between 100 to 1 and 500 to 1, depending on who you ask. What happens when everyone holding paper gold decides they want physical delivery? The system breaks. It's a game of musical chairs, and there aren't enough chairs for everyone playing. We've already seen glimpses of this. In 2020, during the pandemic, there was a brief moment where the futures price of gold diverged from the spot price by over $100 per ounce. That's not supposed to happen. It happened because there was a shortage of physical gold available for delivery in New York while the paper market kept trading. Arbitrageurs who normally keep these markets in sync couldn't get their hands on physical metal to deliver against their contracts. That was a warning shot. A preview of what could happen if confidence in the paper market breaks down completely. And with central banks pulling physical gold out of the market at record rates, we're moving closer to that breaking point every day. Now let's talk about what this means for the average person. Most people think of gold as an investment, something you buy hoping it goes up in value. But that's not really what gold is. Gold is insurance. It's a store of value that's existed for 5,000 years. It's survived the fall of empires, the collapse of currencies, wars, depressions, hyperinflations. It's the one asset that's never gone to zero. When you hold gold, you're not betting that it's going to make you rich. You're protecting yourself against the possibility that everything else loses value. And right now, that possibility is higher than it's been in decades. Think about what's in your portfolio right now. If you're like most people, you have stocks, bonds, maybe some real estate. All of those assets are denominated in dollars. Their value is measured in dollars. If the dollar loses purchasing power, which it's been doing consistently for over a century, then the real value of your wealth is declining even if the nominal numbers go up. This is the hidden tax that nobody talks about. Your 401k might show a balance of $500,000. But what can that $500,000 actually buy? If inflation runs at 6% per year, which is below what we've seen recently, your purchasing power is cut in half every 12 years. That $500,000 will only buy what $250,000 buys today by the time you're ready to retire. Gold doesn't have that problem. Gold maintains its purchasing power over time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. It's not that gold is going up in value, it's that currencies are going down in value, and gold is simply maintaining its position. Here's a story that illustrates this perfectly. In 1920, you could buy a high-quality men's suit for $20. That was also the price of 1 ounce of gold. Today, a high-quality men's suit costs around $2,000. and 1 ounce of gold costs around $4,400. The suit got more expensive in dollar terms, but in gold terms, it actually got cheaper. Gold preserved purchasing power, while the dollar lost 99% of its value. That's what gold does. It's not an investment. It's a preservation vehicle. And in times of monetary instability, it's the most reliable preservation vehicle that exists. Now, let's talk about what happens next. Because the gold price isn't just telling us about the past, it's telling us about the future. And the future it's predicting is one where the current monetary system undergoes a fundamental transformation. There are really only 3 ways this can play out. Option 1 is that governments get their fiscal houses in order. They cut spending, raise taxes, pay down debt, and restore confidence in their currencies. If you believe that's going to happen, I have a bridge to sell you. No government in history has voluntarily chosen austerity when they had the option to print money instead. Option 2 is default. Governments simply stop paying their debts. This would be catastrophic. It would destroy the bond market, collapse the banking system, and trigger a depression that would make 2008 look like a minor correction. It's possible, but it's the nuclear option. Governments will do everything in their power to avoid it. Option 3 is inflation. Print enough money to pay the debts in devalued currency. This is the path of least resistance. It's what every government in history has chosen when faced with unsustainable debt, and it's what's happening right now. The Federal Reserve has already shown its hand. When the banking system was on the verge of collapse in 2023, they created a new lending facility overnight. They printed hundreds of billions of dollars to backstop the banks. When the government needs funding, the Fed steps in. They might call it quantitative easing or emergency lending or whatever euphemism sounds less alarming, but it's all the same thing. It's money printing. And here's the thing about money printing. Once you start, it's almost impossible to stop. Because stopping means allowing the system to collapse. It means letting banks fail, letting the government default, letting unemployment spike. No politician is going to choose that. So they keep printing. And the more they print, the more they have to print to keep the system functioning. This is the debt spiral, and we're in it. The only question is how long it takes before the currency loses so much value that people stop accepting it. That's when you get hyperinflation. That's when a loaf of bread costs a wheelbarrow full of cash. That's when the monetary system breaks down completely. Now, I'm not saying we're going to see Weimar Germany-style hyperinflation tomorrow, but I am saying that the trajectory we're on leads in that direction unless something changes dramatically, and the gold market is pricing in that risk right now. Central banks know this. That's why they're buying gold. They're preparing for a world where the dollar is no longer the unquestioned reserve currency, where international trade is settled in multiple currencies or in gold itself, where the monetary system looks fundamentally different than it does today. The BRICS nations are already building this alternative system. They're creating a new development bank. They're establishing currency swap lines that bypass the dollar. They're talking about a commodity-backed currency that would compete with the dollar for international trade, and they're accumulating gold to back it. If they succeed, and there's a real possibility they will, the demand for dollars will collapse. All those dollars that are currently held overseas as reserves will come flooding back to the United States. That's when you see real inflation. That's when the price of everything denominated in dollars explodes higher. And that's when gold goes from $4,400 to numbers that seem impossible today. Let me give you another historical parallel. In the 1970s, the U.S. faced a similar crisis. The Vietnam War had been financed with printed money. The Great Society programs had exploded the budget. Foreign governments were losing confidence in the dollar. Gold was flowing out of Fort Knox at an alarming rate. Paul Volcker, the Fed chairman at the time, made a decision that's still controversial today. He raised interest rates to 20%. 20%. He deliberately triggered a recession to break the back of inflation. Unemployment spiked. Businesses failed. It was painful, but it worked. Inflation came down. Confidence in the dollar was restored. And the U.S. entered a period of relative monetary stability that lasted for decades. Could we do that today? Technically, yes. But practically, no. The debt levels are too high. If the Fed raised rates to 20%, the interest payments on the national debt would consume the entire federal budget. There would be nothing left for Social Security, Medicare, defense, anything. The government would have to default. So that option is off the table. Which brings us back to option 3. Inflation, it's the only politically viable path forward, and the gold market knows it. Here's what I think happens over the next few years. The Fed will try to maintain the illusion of fighting inflation while actually enabling it. They'll raise rates just enough to say they're doing something, but not enough to actually stop the money printing. They'll use technical language and complex explanations to obscure what's really happening. But the result will be the same. The currency will continue to lose value. Gold will continue to rise. Not in a straight line. There will be corrections. There will be periods where it seems like the rally is over. But the long-term trend is clear. We're in the early stages of a secular bull market in gold that could last for years or even decades. And here's the most important thing to understand. This isn't about getting rich. This is about not getting poor. If you hold all your wealth in dollars or dollar-denominated assets, you're going to lose purchasing power. It's not a question of if, it's a question of how much. The people who understand this are already positioning themselves. They're diversifying out of paper assets and into hard assets. They're buying gold, silver, real estate, commodities. They're protecting themselves against the monetary reset that's coming. The question is, are you going to join them, or are you going to wait until it's too late? Because here's the thing about these major monetary transitions. By the time it's obvious to everyone what's happening, the opportunity to protect yourself has already passed. Gold will be at $10,000 or $15,000 or higher. Silver will be at $100. Real estate will be priced out of reach for most people. The wealth transfer will be complete. Right now, you still have time. Gold is at $4,400. That might seem expensive compared to where it was a few years ago. But compared to where it's going, it's cheap. The central banks are telling you that by their actions. The market is telling you that by the price. The question is, are you listening? I want to leave you with one final thought. Throughout history, there have been moments where the rules of the game changed, where the assumptions that everyone took for granted were suddenly proven wrong, where the people who prepared in advance were rewarded and the people who ignored the warning signs were devastated. We're living through one of those moments right now. The gold market just gave you a signal that's only appeared a handful of times in the last century. Every time it appeared before, the global financial system was reset. The monetary order was rewritten. Wealth was redistributed on a massive scale. This time won't be different. The only question is, which side of that wealth transfer you're going to be on.